Every first Friday of the month, something unusual happens in the Forex market. Spreads widen, traders step back from their screens, and within seconds of a single data release, the euro, the yen, and the pound can move dozens of pips against the US dollar. That report is the Nonfarm Payrolls report, known simply as NFP. Here is what it is and why it matters. The Nonfarm Payrolls report is published by the US Bureau of Labor Statistics every first Friday of the month at 8:30 in the morning Eastern Time. It measures the net change in the number of paid workers in the United States over the previous month. Farm workers and a few other irregular groups are excluded because their employment patterns would distort the overall picture. What remains is a clean monthly snapshot of the U.S. labor market. Alongside the headline jobs number, the report also includes the unemployment rate, average hourly earnings, and the labor force participation rate. All of these matter, but the headline number tends to drive the biggest immediate reaction. So why does one jobs report move the entire Forex market? Because the US dollar is the world's reserve currency. It is involved in the majority of global Forex transactions. Any data that signals strength or weakness in the US economy moves the dollar. And when the dollar moves, every major pair moves with it. NFP also connects directly to Federal Reserve policy. The Fed has two main goals: stable inflation and maximum employment. Strong jobs numbers raise the likelihood the Fed will keep interest rates high or raise them further, which tends to strengthen the dollar. Weak numbers push the Fed toward cutting rates, which tends to weaken it. Interest rate expectations are one of the biggest drivers of currency values, and NFP reshapes those expectations every single month. Reading the report correctly means looking beyond the headline. What really drives the market reaction is how the actual number compares to what analysts expected beforehand. A number that beats the consensus tends to push the dollar higher. A miss tends to push it lower. But also watch the revisions. The Bureau of Labor Statistics regularly updates its prior estimates, and a big downward revision can undercut an otherwise strong headline. Average hourly earnings matter too. Rising wages point towards stronger consumer spending and higher inflation, which is another reason the Fed might hold rates firm. As for trading around NFP, the volatility cuts both ways. Spreads widen, slippage is more common, and the market sometimes moves in the opposite direction of what the data suggests. That is not a glitch. It means the result was already priced in. If you want to understand how NFP affects the pairs you trade, the practical step is to watch several releases on a demo account before risking real capital. Observe the reaction, track the revisions, build a reference point. That preparation is what separates a trader who gets caught off guard from one who has a plan.